All right, man. All things taxes.
You know, March 17th, when we making this video. So yes, a lot of taxes right now.
Preparing taxes and talking about taxes.
That's
What
right.
could happen with taxes, right?
Yeah, you would hope you'd know by now what's going to happen for the 2025 season. But, you know, one thing I learned a long time ago is you don't ever count on what Congress might do, you know, regarding taxes and the administration. But it's at least good to know what could potentially be out there. So that's why we're here today, right?
Hardest thing about taxes, man, is you're playing a game and you don't know the rules.
100%.
Rules could change favorably, unfavorably, who knows?
Right.
So we just want to really jump on here and really talking to dentists, right? Dental practice owners.
Yep.
Specifically, I mean, there's things out there that President Trump's have said regarding, you know, no tax on tips, no tax on overtime, Social Security, et cetera. I just said all I'm going to say about those, if that makes sense, because that really doesn't apply to most dental practice owners.
Yep.
So what we are going to do, and we're going to just ping pong back and forth through these things, right?
Yep.
What President Trump has talked about in kind of on the campaign trail, what you're kind of hearing now, what could potentially happen in this one big, beautiful tax bill that he kind of talks about. So anything before we dive in?
No, I mean, I think we could split this up into two videos almost, Jared, if we have to, because we got individual, we got a state, and we got business. Like you said, they are tied in with dentists pretty much. I mean, there's other provisions in there that would be of note to most people. We're going to kind of gloss over those because I want to keep this pinpointed to our audience in particular. But it might make sense to hit on individual and a state in the first video, and the second video hit on businesses.
Yeah. Well, let's do this. So most of this that we're going to talk about, basically, if you guys remember back in December 2017, I got that right? Yeah, December 2017 is when President Trump was in office, and that's when he passed, or Congress passed, the Tax Cut and Jobs Act.
Massive bill,
right? And so that basically a lot of those provisions, those changes, those favorable changes in that tax bill, most of that stuff was going to sunset. Some of it was permanent, but most of it is going to sunset. 2025 is the last year.
Yeah.
So a lot of the things we're going to talk about, you're going to hear us say extend or make permanent.
Right.
A lot of the things that were in that. So if I'm ready, if you're ready, I'm ready.
Yeah,
that makes
you
sense.
bet. Let's
All right, let's dive in. I'll jump the first one. So first one to just talk about is just basically lower those individual tax rates that extend the reduction of the individual tax rates back on the Tax Cut and Jobs Act. If you guys remember, if you look at those brackets, a lot of the brackets went down maybe like a point or two.
Yep.
You know, depending, and some of them actually widened the bracket regarding increased income requirements on certain brackets. So just all across the board, it basically brought rates down for individual income tax.
Yep. Very simple one. I mean, just extend that out and make it, or make it permanent.
That's right.
One thing to keep in mind is the way they'll probably have to pass this bill is through a Budget Reconciliation Act, I believe is what it's called, which means that there has to be like budget offsets to that. So it may be more of an extension than a permanency, but again, that's the kind of stuff that remains to be seen. Okay, this is an interesting one to me, Jared. Lower top capital gain rate to 15%. You know, right now we know, or most people know, with the higher income brackets that jumped up to 20%. You know, so that's a 5-point spread, getting back to kind of where there's a stable capital gain rate for the higher income earners of 15%.
Yeah, that's right. That'd be a huge one. Huge one there. So number 3, just on the individual side, basically, you know, back at the Tax Cut and Jobs Act again, it basically pretty much doubled the standard deduction across the board on all the different filing status, single, married filing, jointly, et cetera. And basically what it's going to do is kind of just extend that.
Yep.
You know, so not revert back to the lower rates or the lower deduction amount that was in place back in 2017, keep it around, which would be a big deal as well. Yeah,
that one could be a big one. Next one is another one that you know, pretty good deal for a lot of people, which is that child tax credit. You know, right now they're talking about potentially increasing it up to $5,000.
Yeah,
which is a big deal. I mean, again, that could be something that could have a pretty big impact on some of the taxpayers we work with.
Yeah, 100%. So number 5 here, you guys have probably heard us, especially our clients, talk to you guys all the time about it, but I'll just refer to it as the SALT limitations, right? Not going into extreme detail about it, but basically the amount of state and local income taxes you can deduct if you itemize on your tax return. Tax Cut and Jobs Act, this was unfavorable, if you will. It capped it at that $10,000. That's when all these states did the workarounds. You guys have heard about PTE, pass-through entity tax and how that works. What this is going to do that they talk about is basically eliminate that cap and go back to where it was before, which was no cap, basically. Yeah. And so I've heard a lot of things like, I don't know if this is going to happen or not. Who knows? I guess I'll say that. Who knows? But this is what they're discussing.
It's probably one of the more interesting ones on this list because, again, like you said, it was a way to help pay for some of this bill, was that it took away a lot of deductibility of state income tax. So all these states did these workarounds, the pass-through entity tax, and now that could all be null and void. Who knows? This is one I probably wouldn't hold my breath on, but you never know. I mean, it's certainly something that sounds good on the campaign trail. Whether it could get passed, who knows?
Maybe it's job security for us. That's just constantly talking about PTE tax in all these different states.
All right, so last one is this one I think was really helpful because there were situations where we were seeing taxpayers get hit with alternative minimum tax. And with the Tax Cuts and Jobs Act, they just totally changed the way that system is built out and when you're subject to tax. So we saw a lot of people fall out of that and really don't see a whole lot of AMT issues like we used to. So that would be a extension of those favorable AMT rules, which was another deal that's pretty good for most clients.
Yeah, perfect. So here's one. In estate tax, right? So the estate tax exemption, again, go back to the Tax Cut and Jobs Act. It basically, I'm going to say doubled again. It doubled those estate tax exemptions for single, married, filing jointly, et cetera. And what they're going to try to do here is basically keep those permanent.
Yeah, and they're big. They're big numbers for most people.
Huge numbers.
Yeah.
Yeah, and the thing is, if it were to not become permanent, right, and revert back, that's a big change from the increases back in 2017.
Yeah. I mean, what are you talking? Going from 20 million to 10 million, something like that, right. 5 per taxpayer, something in that ballpark. So it's definitely something that will help wipe out estate tax for most people, except for maybe some of our listeners who are building empires. At that point you may have to worry about that. But a lot of people, it takes that concern off the table.
Yeah, 100%. And talk about playing a game when rules can change. I mean, this is definitely one.
And during the Tax Cuts and Jobs Act, they made that tax rate 40%, and this would be making that rate permanent is another provision that's been put out there.
Yeah. Let's dive in. We got time, Bill. We can get through these business ones. Okay. Depreciation, right? You guys are always hearing bonus depreciation. Basically, what they're going to try to do is basically restore it back to the 100% bonus. Yeah. You guys remember when 100% bonus went in place, and then it kind of started toggling down, I guess, from 100 to 80 to 60 to 40. This is kind of like, hey, let's just go back to 100. That's easy for us. I like that. Yep. But if they could put that in place, make it permanent, that's what they're talking about.
Yeah. So this is the one that who the heck knows how this is going to be done. This would be something that, if you recall, had a stair step down. Yep. It was 100, then it was 80, 60, 40. What you could take is bonus depreciation. If they do make it 100, do they make it retroactive? If they make it retroactive, how do they make it retroactive? Stay tuned on this one. This is probably the biggest deal for all of our clients who are in growth mode. It's a fantastic provision, 100% bonus. How it happens and whether you'll be able to go back and kind of recapture some losses in the past, we'll see. We'll see. That's a big one.
And to put it in the dental practice owner's eyes here just a little bit, what we're talking about here and how this specifically pertains, let's just talk about equipment in their business. Yeah. That's that $100,000 CBCT that you buy.
Right.
Again, 100% bonus, you take all that, $100,000.
1 year. A year purchased.
Yeah, as opposed to, let's say now it's 40 or 60. It's a big difference, right?
100%.
So how it gets played back retroactively, what year does it take place in, if it does, is a big deal. Makes planning a little tougher.
Yeah.
But, we're on top of it. We'll make sure you're in good shape.
So let's take a look at R&D. This may be something that for folks who had dental labs and things, they were able to take advantage of the R&D credits, and they were kind of a wonderful thing for a long time until that little ticking time bomb that was put in there to help pay for the Tax Cuts and Jobs Act kicked in a couple years ago, which was, hey, oh, by the way, you can take those credits, but you can't immediately expense the cost that generated those credits. Mm-hmm. A lot of problems came out of that. A lot of people were caught unaware, and it was kind of, like I said, one of those ticking time bombs that blew up in that provision. So we saw a lot of issues there. This would make those immediately expensable. Just like the bonus depreciation, there's been a history of them not being. So what does that mean? Who knows?
Yeah, you couldn't say better. I mean, I think this was like a provision put in the Tax Cut and Jobs Act to like help pay for it, right? Because they had to cut it off at some point, and the amortization is basically not allowing you guys to deduct these expenses. And it
takes a while for it to make sense again. I mean, for it to work itself out so that you're in the black on that deal.
Yeah, and I did see, I think it was last week, and again, we'll see what happens, right? But I did see last week, I think a bill was introduced in the House to make this expensing, I'll just say reverse the amortization.
Yeah.
Right? Who knows what happens? So I don't want you guys to hear this and be like, oh, I just heard that there's a bill, it's going to work. No. A bill is the start of something.
Yeah.
It has to pass.
Don't plan on what Congress might do.
Exactly.
Just understand what they might do.
Yeah. And how far it goes back, we'll see what happens. But there's hope. Let's just see what happens, basically. Okay, QBI deduction restored and made permanent. A lot of different ways. QBI, you guys have heard it, the 20% deduction, the 199A deduction. Basically, it was put in with the Tax Cut and Jobs Act. Again, how this pertains to dental practice owners, you dental practice owners in your practice are that specified service trade or business, SSTB. We say things quick to make us sound smart, but basically, if you're that SSTB, there's specific income thresholds that if you're over, you don't get to partake of this QBI. So this doesn't probably apply to every dental practice owner,
right?
But some. It's a good deal. And if they were able to keep this around and make that permanent, and you're getting the QBI right now, then it would stay around. Yeah. So again, TBD on the QBI, but if you're SSTB, that makes sense.
Yeah, that's a lot of acronyms.
Are we wrapping here?
Yes, I like it. That makes a ton of sense.
Yeah.
The next one up is the limitation on excess business losses. Probably most, sole practitioners or folks who have one practice probably didn't see this, but this really did play into some of our bigger groups who were really in growth mode. And as you know, part of the tax strategy of growth, which I think is a fantastic one, is the ability to depreciate assets over a shorter life and offset current earnings from other portfolio with new acquisitions. Well, if you did too many of those at once, there was kind of a limitation of losses. And it was a large limitation, but we did see it, play in. I think it was in excess of $500K. It can't remember exactly the amount.
Maybe for inflation too.
Exactly. But, if you had multiple locations coming on at once or larger acquisitions, it could limit your ability to take losses. This would repeal that limitation. So for our growing practices could allow for some more in-depth tax planning there.
Yeah, perfect. And the last one we got down here just on key business provisions. Again, corporate tax rates, decrease that from 21% down to 20%. And there's also talk maybe down to 15% if you're domestic manufacturers. And again, think back to the Tax Cut and Jobs Act. I think at that time they reduced it from like 35% or something down to 21%.
Yeah, that's a big deal.
So big reduction. But again, I've had conversations with clients already on this. This is potential stuff.
Right.
So don't jump out and start creating C Corps. Again, this is C Corps, right? Corporate rate.
Yeah.
Don't start. Let's wait and see what happens. And if it does, decrease that much to a more favorable tax treatment, tax rate, we'll see what happens.
Yeah. So, to kind of sum this up, Jared, we're sitting here in March. Some of these things could come in line and be effective for this filing season for 2024, it's tax year. We just don't know. And that's something that, we ask our clients and our people listening to just understand that there's uncertainty in this. There's definitely no, guarantee that any of this will happen. And if there is, there's probably going to have to be spending offsets. So there's maybe some negative things, or there may be some of these provisions that get wiped out. So we'll just have to see, and if something comes out, then our thought is reach out to your CPA and talk to them about it if they're not reaching out to you proactively. And just see, how does it apply to me? Is there anything we need to be doing? But until then, this is good education. We don't know what's going to happen. These are just things that were kind of put forth in the campaign trail that are reasonable expectations, because most of them are already tax law. They're just extending it.
Yeah, 100%. And it's basically three things, right? It's like, if anything's going to happen. Number two, if something does happen, what's going to be in it?
Yeah.
And then number three, when it will be passed. Who knows? I think the Tax Cut and Jobs Act was December.
Yeah.
Like 17th, or I don't know if that's right, but late December.
Yeah.
And so that's the thing, is just figure out, our job is to tell you what can potentially happen.
Yeah.
Talk around those points.
Yep.
Right. And then wait and see what happens.
Education.
That's all we can do is monitor it. I think this is good, Bill. I don't think this will be the last Trump tax plan update we have. But again, we'll monitor it with our data points and see what happens.
And we got it done in one video, so
yeah,
kudos.
See if we can do it next time.
Nice job.
All right, buddy. Appreciate it.
Yep.
See ya.